For decades, the idea that owning a home is always the smartest financial decision has been deeply ingrained in the Canadian psyche. It's often seen as the ultimate sign of financial success, a cornerstone of wealth building, and frankly, a point of national pride. However, what if I told you that this long-held belief is being challenged by recent data, especially in our rapidly evolving Canadian real estate market? We're currently experiencing a period of unprecedented change, prompting us to reevaluate conventional wisdom. Today, we're diving deep into the latest analysis to confront these assumptions and provide you with a clear, data-driven perspective on whether renting or owning is truly building more wealth for Canadians in 2025. Prepare to have your long-held assumptions thoughtfully examined. Let's begin by acknowledging the stark reality of the Canadian housing market. As of December 2025, Canada is navigating what is the second worst price decline for inflation-adjusted home prices going back to 1975. We're talking about a significant 28% peak-to-trough decline, putting it just shy of the record 31% drop experienced in the 1980s. This isn't just a minor blip, it's a major market correction that many experts believe was long overdue. The housing affordability crisis has become one of the most pressing issues for Canadians, driven by a confluence of factors including overly generous monetary policy, high immigration levels straining limited supply, and even more complex issues like foreign investment and money laundering. These factors combined created an unsustainable demand-supply imbalance, making this decline less of a mistake and more of an inevitable rebalancing. For generations, the American dream, or in our case, the Canadian dream, has been synonymous with homeownership. The narrative is powerful: renting is throwing money away, and owning builds equity. This perception has largely been supported by historical trends, but times are changing. Our latest analysis, incorporating 2025 data across 12 major Canadian cities, directly challenges this deep-seated belief. While some assert that, long-term, always buying a home is a good idea, this perspective often fails to account for the crucial elements of affordability, opportunity cost, and the true total cost of ownership. It's time to move beyond emotional attachments and look at the cold, hard numbers that reveal a different story about wealth accumulation in today's environment. Let's get to the most compelling new data point. In 2024, our analysis showed a statistical tie, with hypothetical renters and owners having built essentially equal wealth over the prior 20 years, indicated by an average renter-to-owner wealth ratio of 0.99. However, 2025 has seen a dramatic shift. As real estate prices continued their descent across most major Canadian cities, global stock markets, where our hypothetical renters' capital was invested, remained robust. The result? As of December 31, 2025, the geometric mean wealth ratio across all 12 cities has surged to 1.14. This isn't a small difference. It means that the average hypothetical renter in our analysis built a significant 14% more wealth than the hypothetical owner since January 2005. This finding directly challenges the long-held notion that owning a home is always a wise financial decision. The widening wealth gap between renters and owners isn't a mystery. It's a direct consequence of diverging market performances. While Canadian real estate saw continued price depreciation through 2025, the global equity markets, where hypothetical renters typically invest their down payment and other housing cost savings, experienced robust growth. This dynamic highlights a critical point: the alternative investment. When you choose to rent, the capital that would otherwise be tied up in a down payment, closing costs, and ongoing ownership expenses like property taxes, maintenance, and insurance, can be invested elsewhere. In a period where equities are strong and real estate is weak, this difference becomes incredibly significant, illustrating the power of diversified investments and the opportunity cost of illiquid, concentrated real estate holdings. Here's a crucial pro tip that many people miss. One of the worst ways to make the rent versus own decision is by simply comparing your monthly mortgage payment to your monthly rent. A mortgage payment is not the full cost of living in a home. To get an accurate picture, you must include a comprehensive list of all associated costs. This means adding property taxes, homeowners insurance, ongoing maintenance, and an allowance for major repairs and renovations. Furthermore, don't forget the substantial transaction costs involved in buying and selling, such as real estate agent fees, legal fees, and land transfer taxes. Most importantly, you must factor in the opportunity cost of your down payment, the returns that money could have generated if invested elsewhere. Without considering all these elements, you're making a decision based on incomplete information. Contrary to popular belief, homes are generally not the greatest investments many perceive them to be. While some anecdotal stories of homes appreciating massively exist, especially in specific hot markets like Vancouver, a closer look at inflation-adjusted, net-of-cost returns often tells a different story. For instance, a Vancouver home bought for $51,900 in 1974 and sold for $1.65 million in 2024 represents a compound annual growth rate of 7.16%. While respectable, let's put that in context. Over the same 50-year period, the MSCI World Index, representing the global stock market, returned 10.2% annualized in Canadian dollars, and the TSX returned 9.44%. This illustrates that while housing can provide returns, it's often outperformed by diversified equity investments, especially after accounting for all ownership costs. Your home is a place to live, not necessarily your best investment vehicle. One of the most overlooked financial principles in the rent versus own debate is opportunity cost. This refers to the value of the next best alternative that you forego when making a choice. When you commit a substantial down payment and ongoing capital to homeownership, that money is no longer available to invest in other assets, such as a diversified portfolio of global equities. The lost returns from these alternative investments represent a very real cost of homeownership. Furthermore, while leverage can amplify gains in a rising market, it also magnifies losses in a declining one. Unlike a diversified investment portfolio, your home is a single, when diversified asset, carrying concentrated risk. Savvy investors understand that true wealth is built through broad market exposure, not concentrated bets on a single property. Many people view a mortgage as a unique, wealth-building hack, a special kind of debt that magically makes you rich. While it's true that the principal portion of your mortgage payment builds equity, it's crucial to remember that a mortgage is still a significant debt instrument with interest payments. These interest payments, especially at higher rates, are a direct cost that doesn't contribute to your equity. The idea that a mortgage automatically makes you wealthier needs to be critically examined against the backdrop of what that same capital could achieve if invested differently. The forced savings aspect of a mortgage is beneficial for some, but it's not the only or necessarily the most efficient way to save or build wealth, particularly when considering the total financial picture and opportunity costs. There's a common misconception that once you've paid off your mortgage, your housing costs plummet, and you achieve true financial freedom. While it's certainly liberating to be debt-free, paying off your mortgage doesn't magically eliminate all housing-related expenses. You're still responsible for property taxes, which can be substantial and continue to rise, homeowners insurance, and the ongoing, often unpredictable, costs of maintenance and repairs. Furthermore, the capital tied up in a fully paid-for home might represent a significant opportunity cost. That capital could potentially be generating returns in a diversified investment portfolio, rather than being locked into a single, illiquid asset. So, while the absence of a monthly mortgage payment is a relief, it's vital to maintain a holistic view of your financial situation and the true ongoing costs of homeownership. Our relationship with our homes is deeply emotional, and this often leads to significant behavioral biases when making financial decisions. One such bias is salience bias, our tendency to focus on information that stands out due to its prominence, emotional impact, or vividness. For homeowners, this often means fixating on the initial purchase price and the eventual sale price, especially if the latter is significantly higher. The emotional weight of buying and selling a home, often involving intense negotiations, amplifies this focus. What often gets overlooked are the less glamorous, but financially significant, ongoing costs, interest, taxes, insurance, and maintenance. When homes are tied to our identity and social standing, it becomes incredibly difficult to view them purely as financial assets, which can lead to suboptimal financial outcomes. One argument often raised in favor of buying is the dire warning that a 40-year-old who never buys a house will be really pissed when they're 80, due to ever-increasing housing costs. It's true that the cost of housing, whether rent or ownership expenses, will almost certainly increase over a 40-year period due to inflation and market dynamics. However, this argument misses a critical component, the alternative. The hypothetical renter isn't just throwing money away, they are, ideally, diligently investing the difference between their rent and the total cost of ownership into a diversified portfolio. This invested capital also grows over 40 years, offsetting or even surpassing the rising costs of housing. The question isn't whether costs rise, but which strategy, owning or renting and investing, provides better inflation-adjusted wealth and peace of mind in the long run. Despite the data we've discussed, homeownership is absolutely the right choice for many individuals. So, who should consider buying? Firstly, you should be in a financially secure position, with a stable and ideally high income that comfortably covers all aspects of homeownership, not just the mortgage payment. Secondly, you need a long-term commitment to a specific location, typically 5 years or more, to absorb transaction costs and potential market fluctuations. Beyond finances, if you deeply value the stability, permanence, and ability to customize your living space, or want to put down roots in a specific community, then owning might align better with your lifestyle goals. But remember, buying a home you can't afford is not a good idea. Affordability should always be the paramount consideration. Conversely, who should seriously consider renting? Renting becomes a compelling option for those who prioritize financial flexibility and liquidity. If your career path involves potential relocation or your life circumstances might change in the near future, renting offers unparalleled freedom. It's also the financially prudent choice for anyone who, after a thorough calculation, realizes they cannot comfortably afford the total cost of homeownership, including all the hidden expenses. Renters can redirect their uncommitted capital, what would be a down payment, property taxes, maintenance, into a diversified investment portfolio, potentially achieving greater long-term wealth accumulation with less concentration risk. For many, especially in the current market, renting and investing wisely is proving to be the superior financial strategy. While our focus has largely been on the financial aspects, it's important to acknowledge the significant lifestyle factors that play into the rent versus own decision. Renting offers immense flexibility, the freedom to move easily for new job opportunities, to explore different cities, or simply to adapt to changing life stages without the burden of selling a property. You're also free from the constant responsibility of maintenance, repairs, and property taxes, which can be a significant source of stress and unexpected costs for homeowners. On the other hand, owning provides a sense of permanence, the ability to personalize your living space without restriction, and for many, a deeply rooted psychological comfort. However, it's crucial not to conflate homeownership with guaranteed happiness. Personal satisfaction comes from many sources, and financial peace is often a greater contributor than simply owning a title. Ultimately, the decision to rent or buy is deeply personal and depends on your unique financial situation, lifestyle, and goals. My most important pro tip is this: do not rely solely on general market trends or anecdotal evidence. You must run your own specific numbers. There are many excellent online rent versus own calculators available that can help you input your income, savings, expected property taxes, insurance, maintenance costs, and potential investment returns. Be honest with your inputs and consider your expected timeline in a particular location. If you're planning to move in just a few years, the transaction costs of buying can quickly erode any potential gains. For personalized guidance, consider consulting with a fee-only financial advisor who can help you navigate these complex calculations and align them with your broader financial plan. In closing, the Canadian housing landscape in 2025 presents a compelling case for critically re-evaluating the long-held belief that owning a home is inherently superior to renting. Our analysis, updated with the latest data, clearly shows that for many, renting and strategically investing the saved capital has proven to be a more effective path to wealth accumulation. This isn't an attack on homeowners, rather, it's an invitation to embrace financial literacy and make decisions based on comprehensive data and personal circumstances, not just societal pressures or emotional attachments. Whether you choose to rent or buy, the goal should always be to optimize your financial well-being. By understanding the true costs, opportunity costs, and market dynamics, you can make an informed decision that genuinely supports your long-term financial health and overall life satisfaction. Thank you for joining us in this crucial discussion. Thank you for watching. If you liked this video, please like and subscribe.